Hi, I'm Deirdre McMurdy. Our guest today has two really hard and fast rules when it comes to investing. Rule number one, avoid losing money. And rule number two, always remember rule number one. We're talking about Michael Hatcher. And Michael is the portfolio manager for the Trimark Global Fundamental Equity Fund. He's also the head of Global Equities for Trimark Investments and the director of research. Michael, great to see you. I know our viewers are going to be very keen to hear your insights today. Let's start right at the beginning. What inspired you to become a portfolio manager?
Yes, I started my career off as an economist. So many years of school, learning the economic principles. And what I found was I really wanted to move away from economics and into investing. So to do that, I needed to read as widely as I could. So I read as many books as I could, as many articles as I could. And I finally came across a book by an author named Roger Lowenstein, The Making of an American Capitalist, which is the biography of Warren Buffett. And it was the simplicity of just simply trying to uncover quality businesses and buying them for less than what they're worth, or buying $1 worth and paying 50 cents. That led me away from economics and into being a value investor.
Well, then maybe you could tell us a little bit about the process, the research, the analysis that goes into finding those companies, because I'm sure investors must wonder, how do you go about picking what goes into the portfolio?
Right. The key for us is the quality of the company. So how I define quality, I'm looking for businesses that generate high returns, or high returns on their capital. So what do I mean by that is, for every dollar a company maintains, what return can they get on that? So a 15 or a 16, 17% return on capital. I'm also looking for companies that generate significant cash. But for that cash, it needs to be cash that sort of comes back to you as a unit holder. So these are companies that will, if you had $1 of earnings, let's just use an example, and you had an auto manufacturer that had to take 40 cents of that and put it back into the company just to produce the same number of cars, you don't really have $1, you really only have 60 cents. So we're focused on how much cash will actually come back to me as a unit holder. So a quality company is going to be something that has those attributes, and what we're looking for in order to make sure they have them for a long period of time is that there needs to be something, a competitive advantage or a barrier to entry that stops people from competing against those businesses, because that's what allows them to have these returns on capital and generate cash for long periods of time. So that's really what we're focused on, is that competitive advantage.
Now, some of the big names that you own, Michael, are names like Walt Disney and Microsoft, Johnson & Johnson. What's attracted you to businesses like these ones?
It would be those same attributes. These are businesses that with significant competitive advantages. If you think about Walt Disney, Walt Disney, a significant portion, or 30% of that company, is ESPN. So basically they dominate the sports broadcasting market in the US. If you make the argument that TV is fragmenting, you're getting all kinds of different different stations, different internet, everybody still wants to watch sports live. So you still have a very strong franchise of live content, and that's 30%. And then when you go down sort of the business model, whether it be the theme parks or whether they be the Disney Channel, they have very strong franchises that they're able to actually generate significant cash, and it's that stability and growth of the cash flows that we're actually looking for. And that's consistent across many of the companies that you just named.
And Michael, in the Trimark Global Fundamental Equity Fund, you've got about 75 company names, but several of those are in Europe or in the US, and investors are understandably sometimes a little bit skittish about that kind of exposure. What do you say to them about that?
I think the key is that we're not buying those economies. So when I say that, in Europe or European exposure, we're not buying the economies of the underlying countries. What we're looking for are great investment opportunities in individual companies. And that's very different than a broad geographical exposure or broad GDP exposure of the European continent or the US market. And to give you an example of that is, Nestle, sort of a long-term holding within the portfolio. 40% of their revenue is actually generated in the emerging markets. And I can give many examples within the portfolio where it's a UK company or it's a European-based company, but their actual exposure or their revenue and their profits are really generated across the world. So I'm much less concerned about saying that I have exposure to companies in the US or in Europe specifically than I really am about uncovering these businesses with global franchises.
Okay. And finally, what advice would you give to investors who want to increase their wealth? Why should they look to increase their wealth through your fund?
The best way to increase your wealth is first thing to preserve it. Make sure that it goes back to rule number one is don't lose money. And then from there you want to compound it. The best way to do that, in my opinion, is own great businesses that are able to compound their underlying earnings for long periods of time. Try to make as few decisions as possible by not trying to buy and sell or not try to time the market. You're really trying to take advantage of franchises that will just generate and continually compound themselves over long, long periods of time. And that's in essence what we do in all of our portfolios at Trimark.
Well, thank you very much. Great insights, Michael. A pleasure to speak with you.
Great, thank you.
And for those viewers who are interested in learning a little bit more about the Trimark Global Fundamental Equity Fund, speak to your advisor.